It's done. Greenland just crashed the silver market, not with a headline, not with a press conference, but with a document, 89 pages, uploaded Friday afternoon, January 17th, 2026, when most markets were already closing, buried inside. A single paragraph, 2 billion ounces of silver, one deposit, one location. And while the futures screen still shows $93 per ounce, actual metal, delivered to the Arctic region, is trading at $137. That's not a premium, that's a fracture. And what happens next will determine who controls the global silver supply for the next decade. Because the paper price just lost its authority. Welcome to Currency Talks. If you've been in business long enough, you know the difference between noise and signal. This is signal. Now, we realize most of you watching right now haven't subscribed yet. And we understand you're cautious. You've been burned before by channels that overpromise and underdeliver. But here's what we ask. If you value strategic economic intelligence, the kind that arrives before the mainstream catches on, hit that subscribe button. Not for us, for yourself. Because the next 6 months will separate those who saw this coming from those who scrambled too late. And before we continue, drop a comment below. Tell us, where in the world are you watching this from right now? Are you in North America, Europe, Asia, the Middle East? We want to know, because regional positioning matters in what's coming. Now, let's break down exactly what happened and why the silver market as you knew it just ended. On Friday, January 17th, 2026, at exactly 4:47 p.m. Eastern Time, something quietly appeared on a United States government website. No announcement, no press release, no fanfare, just an upload. 89 pages of technical mineral assessment data, the kind of document that puts most people to sleep by page 2, charts, tables, footnotes, core sample jargon, geological terminology that reads like a foreign language to anyone outside the mining industry. But buried deep inside that document, around the middle, was a single paragraph. And that paragraph changes everything. Because what it describes is not just another mineral deposit, it describes a concentration of silver so large, so strategically positioned, and so geologically significant that it does not simply affect silver prices. It threatens the entire way silver is priced globally. The deposit sits in northern Greenland, far up near the Arctic Circle, a region most people only associate with ice, polar bears, and military radar stations. But according to the updated assessment, advanced testing has now detected silver concentrations that were not identified in previous surveys. And the numbers are not small, they are world-altering. The estimate given in the report is approximately 2 billion troy ounces of silver in a single deposit. To understand what that means, one must look at global context. Last year, the entire world mined somewhere between 800 and 900 million ounces of silver. Total, from every mine, from every country. Combined, so this one Arctic deposit, if the numbers hold true, if it can be developed, if it can be controlled, represents roughly 2.5 years of total global mine supply, sitting in one location. And not just anywhere, in a place that currently sits at the center of an escalating geopolitical struggle between the world's largest economic powers. Now, here is where timing becomes critically important. The sampling window mentioned in the report points to last summer through early fall, June through October of 2025. That means the assessment work was essentially completed months ago. The data was analyzed, the conclusions were drawn, the report was finalized, and yet, the document only became publicly available on January 17th, 2026. The same week, Washington intensified diplomatic pressure on European allies regarding Arctic strategy. The same week, Greenland became a recurring headline in international news. The same week, language around tariffs, territorial negotiations, and strategic resource security began circulating at the highest levels of government. Some will call this coincidence, others will call it coordination. But those who understand how strategic resources are managed at the national level recognize a pattern, and the pattern is too precise to ignore. Now, before anyone assumes this is merely a political story with no immediate market impact, they need to understand what is currently happening in the physical silver market. Because there is a price, and then there is the real price. The price most people see when they check their phones or computer screens is the futures price. It is the price discovered in the paper market, where contracts are traded, where most transactions never result in actual physical metal changing hands. On Friday, when the report was uploaded, the futures close was hovering around the low to mid $90 range per ounce. That is the official number. That is what the financial apps display. But if someone actually tries to purchase physical silver, the kind they can hold in their hand, they are not paying $93. They are paying $93, plus a premium. And those premiums have not been behaving normally. Government-minted coins, the products people trust most, Maples, Eagles, Britannias, are carrying premiums significantly above historical averages. Even generic rounds, the cheapest category available, are showing premiums that suggest stress, not simple supply and demand convenience. This is the surface level symptom. But underneath, at the wholesale level, something more serious is developing. The market is beginning to split. And when markets split between paper pricing and physical reality, dangerous dynamics emerge. Because the entire global pricing system for silver depends on one critical assumption: the assumption that the paper price and the physical price are close enough to be trusted as the same thing. That assumption only holds as long as the world believes a futures contract can be converted into actual metal without significant difficulty. But when physical metal begins trading at substantially different levels depending on location, that belief starts to crack. And recently, information has surfaced from sources involved in Arctic logistics. Individuals who handle shipping to remote northern ports, people who supply operations in Canada, Alaska, and the Greenland corridor. According to these sources, physical silver quoted for delivery into certain Arctic nodes is being discussed at numbers that seem disconnected from reality, if one only watches the COMEX screen. The number being mentioned is $137 per ounce. Let that register. Futures quote $93, Arctic delivery quote $137. That is a premium of over $40 per ounce. That is not a tight market. That is not normal supply chain friction. That is the breakdown of a single unified global price. That is regional pricing based on access, security, and control. And when silver stops behaving like a commodity and starts behaving like a strategic resource, everything that happens next changes. Most people hear the word mine and imagine a hole in the ground, trucks, conveyor belts, workers in hard hats, a business operation. But what sits beneath northern Greenland is not just a mining opportunity. It is a geological anomaly that rewrites the global map of strategic materials. And understanding why requires looking past the surface into the rock itself. The report describes average silver concentrations measured in hundreds of grams per ton. For those unfamiliar with mining economics, that language might sound technical and meaningless. But in the world of mineral extraction, grades matter more than almost anything else. A deposit with a few grams per ton is marginal. 50 grams per ton starts to become interesting. 100 grams per ton catches serious attention. But when concentrations push into the hundreds of grams per ton across a rock body measured in billions of tons, that is exceptional. That is rare. That is the kind of geology that makes nations reconsider their entire resource strategy. And Greenland's deposit does not stand alone. The report also mentions companion metals, zinc, lead, other base metals embedded within the same mineralized structure. This is critical because silver mines almost never produce pure silver. They are usually byproduct operations. Silver comes out alongside copper, or gold, or zinc. And when a deposit offers both high-grade silver and economically viable base metals, the project economics improve dramatically. It transforms from a single metal gamble into a diversified industrial operation, the kind that can justify massive infrastructure investment, the kind that governments find worth subsidizing, because this is where the geology stops being just science and becomes geopolitics. Now, let us talk about where this deposit actually exists. Northern Greenland, Arctic Circle territory. A region where winter darkness lasts for months, where temperatures drop to levels that freeze machinery, crack steel, and turn routine operations into survival challenges, where the sea itself becomes impassable for half the year, locked in ice. There are no roads leading to this location, no ports, no power grid, no runways capable of handling heavy cargo aircraft, no communication infrastructure, no worker housing, no medical facilities, nothing. From an operational standpoint, this is not a remote mine. This is the construction of an industrial city in one of the harshest environments on the planet. And the list of requirements is staggering. A deepwater port capable of handling bulk carriers year-round, which means engineering solutions for ice management that do not currently exist at this scale. An airport runway long enough and reinforced enough for large freight planes, built on permafrost that shifts and heaves with seasonal temperature changes. All-weather road networks connecting mine sites to processing facilities to ports, requiring continuous maintenance in conditions that destroyed pavement within years. Power generation on a massive scale, not small backup generators. Permanent industrial-grade electrical infrastructure capable of running crushers, smelters, refineries, heating systems, and an entire town's worth of buildings, around the clock, in sub-zero temperatures. Processing facilities to separate silver from host rock and companion metals. Worker housing for potentially thousands of employees, rotating in and out on scheduled shifts because no one lives there permanently. Medical centers equipped for trauma, cold weather injuries, and emergency evacuations. Environmental control systems to manage waste, water, and emissions in a fragile Arctic ecosystem under international scrutiny. And then, security. Because in a region where geopolitical competition is intensifying, any operation of this scale becomes a strategic asset that requires protection. This is not a mine. This is a colony. And colonies are not built by private companies chasing profit margins. Colonies are built by nations chasing strategic advantage. Now here is where the real game reveals itself. The value of this deposit is not in digging up silver next year. The value is in controlling who gets access. 10 years from now, 20 years from now, during the exact period when global silver deficits are expected to peak. Because once infrastructure exists in the Arctic, it does not only serve one mine, it opens an entire corridor. Suddenly, other deposits in the region become economically viable. Rare earths, uranium, copper, cobalt, lithium, all of these materials exist in Greenland's geology. But without roads, ports, and power, they stay in the ground. The moment someone funds the infrastructure for silver, they unlock access to everything else, and whoever controls that infrastructure controls the valve. They decide who gets priority contracts. They decide export permissions. They decide which countries receive supply during shortages and which countries get cut off. This is why the investment numbers being discussed are so enormous. Some reports mention $300 billion or more in total development costs when factoring in everything required to make this region functional. That is not a business investment. That is a sovereign wealth fund deployment. That is a national security budget item. And it only makes sense if the goal is not profit in 5 years, but leverage for 50. So the question is not whether Greenland has silver. The question is who will pay the price to own the doorway. Because the nation that builds the port owns the export route. The nation that builds the runway owns the airlift capability. The nation that builds the power grid owns the operational tempo. And in a world where silver is embedded in solar panels, electric vehicles, defense systems, medical devices, and grid infrastructure, ownership of future supply is not a commodity play. It is a strategic imperative. And that is why this geology, this frozen, remote, expensive geology, just became one of the most contested pieces of ground on Earth. There is a moment in every market's life when the agreed-upon fiction stops working, when the convenient lie everyone pretends to believe can no longer hold. And for silver, that moment may have just arrived. To understand what is happening right now, one must first understand how silver is actually priced. Most people believe the price of silver is determined by supply and demand. Buyers and sellers meeting in a marketplace, negotiating until they agree on a number. Simple, transparent, fair. But that is not how modern silver pricing works. The price that appears on financial websites, trading apps, and news tickers is not discovered in a physical marketplace. It is discovered in a futures market, a paper market, a market where contracts representing silver are bought and sold, but the vast majority of those contracts never result in actual metal changing hands. They are settled in cash. The buyer pays the difference. The seller collects. No silver moves. And this system works perfectly well, as long as everyone believes in one critical assumption. The assumption that if someone really wanted to, they could convert that paper contract into real, physical silver without significant trouble. That belief is what holds the entire pricing mechanism together. It is the foundation. The moment that belief cracks, the system fractures. And right now, across multiple markets, across multiple geographies, that crack is widening. Because while the futures screen shows silver trading in the low to mid $90 range, the real world is telling a very different story. Walk into a coin shop in Texas. The premium on a silver eagle is not $2 anymore. It is $8, $10, sometimes $12. Call a dealer in Ohio. Ask about generic rounds, the cheapest product available. The response is not, sure, spot plus $2. The response is, if we can even get them, you're looking at spot plus $6. And delivery is 3 weeks out. Check online retailers, the ones with live inventory counters. Watch how fast the numbers drop when a new shipment posts. Minutes, sometimes seconds. This is not normal demand. This is not healthy market behavior. This is stress. Now, retail premiums are visible. They are the surface. But underneath, in the wholesale market where dealers buy from refiners, where refiners buy from miners, where large institutions lock forward contracts, that is where the real separation is happening. Because institutional buyers do not purchase one coin at a time. They purchase tonnage. They lock 6-month contracts, 12-month contracts. And when they make those calls right now, the quotes they are receiving do not match the screen. One source, someone who handles logistics for Arctic mining operations, someone who ships equipment and supplies to remote projects in Canada, Alaska, and yes, the Greenland corridor. That source recently described a conversation about securing physical silver for delivery into northern ports. The number quoted was $137 per ounce, not for small quantities, for bulk delivery. Industrial scale, futures screen, $93. Arctic physical, $137. That is a $44 gap. That is not a premium. That is a completely different market. And this is where the fracture becomes dangerous. Because once physical silver starts trading at radically different prices depending on geography, the idea of a single global price becomes meaningless London quotes one number, New York quotes another, Shanghai quotes a third, and now the Arctic quotes a fourth. When that happens, the paper price loses its authority. It stops being the price. It becomes a reference, a suggestion, a number people glance at, but do not actually pay. Now, why is this happening? Because the world is consuming more silver than it is producing, and it has been for years. The gap is being filled by draining stockpiles, ETF inventories, vault reserves, government holdings, private stashes accumulated over decades. But those above-ground supplies are finite. And every year the deficit continues. The margin for error shrinks. Meanwhile, demand is accelerating. Solar panel manufacturing requires silver paste, conductive, irreplaceable in current technology. Every panel needs it, and the world is installing solar faster than ever. Electric vehicles use silver in battery contacts, in circuit boards, and charging infrastructure. Every EV rolling off the line consumes silver. Grid upgrades, the infrastructure being built to handle renewable energy loads, require silver for switching systems and conductive pathways. Medical technology, antibacterial coatings, diagnostic equipment, specialized imaging systems, defense electronics, missile guidance, radar, communications. Silver is not optional in these applications. It is not a luxury. It is a functional requirement. And none of these industries are slowing down. So demand keeps climbing, while mine supply remains relatively flat. Because most silver is not mined for silver. It is a byproduct. 70% of global silver production comes from mines that are primarily digging for copper, zinc, lead, or gold. Silver just happens to come along. Which means when silver prices rise, production does not immediately respond. Because miners are not making decisions based on silver economics. They are making decisions based on copper economics, or zinc, or gold. So even if silver doubles in price, new supply takes years to arrive, permitting exploration, development, construction. A decade, sometimes more. This is the structural problem. Demand rising, supply constrained, inventories draining, and now, layered on top of that, a 2 billion ounce deposit appears in a geopolitically contested zone. And suddenly, the conversation changes. Suddenly, silver is not just a market commodity. It is a strategic asset. And when governments start thinking strategically about supply, they do not behave like investors. They behave like planners. Planners do not wait for lower prices. Planners build buffers. They stockpile. They lock contracts years in advance. They secure supply, regardless of cost. Because in their calculus, the risk is not overpaying. The risk is being cut off. And when enough large players start thinking that way, the paper market has a problem. Because the paper market depends on liquidity. It depends on sellers willing to deliver. It depends on confidence that contracts are backed by real metal in accessible locations. But if metal starts disappearing into strategic reserves, if refiners prioritize long-term government contracts over spot market sales, if delivery timelines stretch from days to weeks to months, then the futures price stops reflecting reality. It reflects what people hope the price should be, not what they can actually buy metal for. And that gap, that widening gap between hope and reality, is exactly what premiums are screaming right now. The market is fracturing, paper is losing authority, and the people paying attention are not waiting for confirmation. They are moving, right now. There's a pattern that repeats throughout history, a pattern so consistent, so predictable that once someone learns to recognize it, they can see the future before it arrives. It goes like this. An essential material exists in abundance until suddenly it does not. A unified global market functions smoothly until suddenly it fractures. And the people who saw it coming position themselves months or years before the public even realizes something changed. Oil in the 1970s followed this pattern. For decades, oil was just a commodity, traded freely, priced globally, available to anyone willing to pay market rates. And then, in a matter of months, it became a weapon. Export restrictions, embargo decisions, strategic alliances determining who received supply and who did not. The price did not rise politely. It exploded. And the world spent the next decade restructuring entire economies around the new reality. Rare earth elements followed the same script in the 2010s. For years, they were obscure materials most people had never heard of, mined quietly, exported freely, priced as commodities, until one country, which controlled the majority of global production, decided to restrict exports. Suddenly, rare earths were not commodities anymore. They were strategic leverage, prices spiked, supply chains collapsed, nations scrambled to rebuild domestic production capability, a process that took nearly a decade. The common thread in both cases is simple: essential material, concentrated control, geopolitical trigger. And then, everything changes. Silver is now entering that same pattern. Not because someone decided it should, but because the conditions are aligning in a way that makes it inevitable. Silver is essential. It is embedded in technologies that define the modern world. Solar energy, electric vehicles, consumer electronics, medical devices, defense systems. None of these industries can function without it. And unlike gold, which sits in vaults as a store of value, silver gets consumed, it gets used, spread thin across billions of devices, unrecoverable in most applications, which means the world needs a constant, reliable flow of new supply. But that supply is not growing fast enough. And now the largest undeveloped deposit on record sits in a location where two superpowers are quietly preparing to fight for influence. Not with military force, with infrastructure commitments, diplomatic agreements, financial packages that rival the GDP of small nations. Because whoever controls Greenland's resources does not just control silver. They control leverage over every industry that depends on it. Now, here is what most people miss. Markets do not wait for mines to open. Markets do not wait for production to begin. Markets move the moment the future changes, and the future changed on January 17th, 2026. Because the moment that report became public, every strategic planner, every supply chain manager, every government resource analyst, they all started running the same calculation. If the United States secures exclusive development rights, what happens to global supply availability? If China secures those rights instead, what happens to Western manufacturers? And if neither side wins quickly, if Greenland plays both sides for maximum concessions, what happens to price stability during years of uncertainty? The answer in all three scenarios is the same: volatility, scarcity premium, regional pricing, stockpiling behavior. Because when supply becomes a political variable, buyers stop optimizing for price. They start optimizing for access. And that shift changes everything. Now, let us talk about what to watch in the coming weeks, because the signs of systemic fracture are already visible for those who know where to look. First, delivery timelines. If a buyer orders physical silver today and is told delivery will take 4 weeks instead of 4 days, that is not a logistics issue. That is an inventory issue. Second, product availability. If the cheapest products, generic rounds, plain bars are selling out while premium products remain in stock, that is not normal buying behavior. That is panic buying disguised as bargain hunting. Third, simultaneous premium increases. If dealers in Texas, Ohio, Arizona, and Florida all raise premiums within the same week, they are not independently deciding to be greedy. They are responding to wholesale cost pressure. Fourth, buyback spreads. If local coin shops are offering stronger buy prices, narrowing the gap between their sell price and their buy price, it means they are confident they can resell quickly. It means demand at the retail level is outpacing supply. And fifth, exchange behavior. If futures exchanges start raising margin requirements, if they tweak delivery rules to encourage cash settlement, if they implement emergency measures in the name of market stability, those are not precautions, those are warnings. Because exchanges do not change rules randomly. They change rules when pressure builds, when too many contracts threaten to demand physical delivery, when the system gets stressed. Now, the question everyone wants answered is this: what happens to the price? And the honest answer is, it depends on which price someone is asking about. The futures price could do anything in the short term. It could spike, it could crash, it could chop sideways while traders debate the meaning of every headline, because the futures price is driven by sentiment, by leverage, by algorithmic trading, by speculation. But the physical price, the price at which real metal actually changes hands in the real world, that price is driven by something much simpler: availability. And availability is tightening, not in a way that shows up on a chart, but in a way that shows up in delivery delays, in premium expansion, in dealer conversations, in wholesale quotes that do not match the screen. And when a strategic deposit enters a contested zone during a structural supply deficit, availability does not improve, it gets worse. Because governments hoard, institutions stockpile, manufacturers lock long-term contracts, and every ounce that moves into strategic reserves is an ounce that does not reach the open market. So the real question is not where the futures price goes next week. The real question is this: when physical silver is trading at $137 in the Arctic, when premiums in the retail market are $8, $10, $12 over spot, when delivery timelines are stretching to weeks, how long can the paper price pretend everything is normal? How long can a system built on confidence survive when confidence is breaking? And what happens when enough people realize the screen price and the real price are no longer the same thing? History suggests the answer. The paper price either snaps upward violently to catch reality, or it loses relevance entirely as the world moves on without it. Now, there is one more element to this story that deserves attention: the narrative war. Because as this story spreads, two types of media coverage will emerge. The first will be dismissive. Greenland as a joke, silver as a relic, the deposit is irrelevant because it is remote, expensive, and years away from production. The second will be reassuring. Experts explaining that there is plenty of silver, that markets are stable, that concerns are overblown. Both narratives serve the same purpose: to keep the public calm, to discourage a rush into physical, to protect the paper pricing mechanism. Because if too many people move into physical at once, if retail buyers, institutional buyers, and governments all start competing for the same limited inventory at the same time, the system does not bend, it breaks. And the people who understood that ahead of time are the ones who positioned accordingly. So the final question is not what will happen. The final question is, who will be ready when it does? Because the silver market, as it existed for the last several decades, just ended. What comes next will not look like what came before. Regional pricing, strategic stockpiles, political allocation. This is not a commodity anymore. This is leverage. And leverage in the hands of nations competing for the future does not trade quietly. It trades violently. The setup is complete. The trigger has been pulled, and the only thing left is watching how fast the world realizes what just happened.